Hey, thanks, Preet. So as Preet said, we're talking about money matters today, and I see a couple of people from the UK in the chat. So hi, I'm based in Canary Wharf, if anyone is close to it. But we're talking about financial literacy today for the creative entrepreneur. It's really focused today on solo businesses, small businesses, and kind of trying to keep it pretty practical. And I'll make a few promises, but my goals today are no spreadsheets. There will be some numbers, but there will be no spreadsheets. Also, I want to give you some confidence to engage with finance. Like, it can be a pretty scary topic for many people. So the whole idea today is kind of get over that hurdle and really get that confidence to engage with this as a topic. And lastly, I want it to be really practical. Right? I don't want this to be sort of some boring theory that you can read in an accounting book. This is about how does this apply to you running your own small business. And with that, quick agenda. Because I'm an engineer by heart, I start at zero when I count. So quick intro about me, why you should listen to me. Then we'll talk a little bit about the mindset of like, how do you need to kind of reason and think about finance and running your business. We will dive into a few financial concepts after that, and then really go, how does all of that apply to your practical kind of day-to-day life of being in your own business. So really quickly about me, as Preet said, I've been a CTO for 10 years. I've done this for startups running 5-people teams. I've done this for big public companies running hundreds of people. I've bought and sold businesses worth several millions in the process. I'm an active investor. I'm a startup advisor. And more than anything, I'm a strategy consultant, which means I look at businesses and go, hey, what should you be doing? Now, the reality is you can't do any of those things without really understanding the finances that drive a business. And so that's the hard part of gaining the experience doing this for 10, 15 years. The easy part, which everyone can do, is to go out there and read a book on accounting basics, or do what I do and study for an MBA and just focus on corporate financing. Go on a Udemy, find your courses, but be aware that combination of theory and practice is what makes it valuable and makes it worth listening to. And the one thing I can tell you, after having done this for quite a few years, having seen this in small business, seen this in big businesses, is that finance is the same for every business. The only real difference is the size of the number. Right? The number of zeros at the end is what really makes a difference. And as we go through the presentation, we'll touch on that a few times, and we'll put this in practice to really see how they are exactly the same. And this is why people often say finance is the language of business. That's what's behind it. It's the same for every business. But before we dive into the kind of nerdy finance parts, let's talk a little bit about the sort of mindset that comes with businesses. And to do that, I'm going to tell you a story about Olivia. And Olivia was a senior designer at Acme Corp. Some of you might remember Acme Corp from the Roadrunner cartoons if you're my kind of age and you grew up around here. But Acme Corp, as most companies through COVID, had to downsize. And therefore, Olivia sadly was without a job. And as we all know, no job means no income, right? The sad consequence of not having a job. And while applying for jobs is a good thing, it's not easy, it's hard, and actually it doesn't really pay for the rent or food or anything. So a bit of an annoying situation, particularly with the market we're in these days. Now, Olivia was pretty lucky. And she was lucky because she had a friend who went, hey, I've got a short project in my company I could use your help with. Could you do sort of a freelance designer thingy for me for a little while? And so Olivia quite liked that. And she set up a company. And she thought, you know what, this freelance thing, it might help me earn a bit of money while I look for a job, or sort of see what happens, or maybe it turns into a full-time thing in its own right. So it was a free option, so to speak. Now, the important part is that she set up a company. She doesn't do it as herself. She makes a distinction between Olivia's personal finances and her company, which earns money for doing design work for others. We'll come back later of why that matters, but this separation is something you can actually use to your advantage personally. Now, Olivia did this project, and she realized that the next big problem was that she actually needed better friends, because all her friends are designers or engineers or people who are at her level. Very few are in a position to hire other designers to come and help on projects. So she goes, okay, I need better friends. That is a problem. And inevitably, you end up looking at stuff like, the likes of Fiverr and Upwork, and you're going to be able to get started on those. Like, if we're being honest, you'll find a project there, but it's hard to sustain and it's hard to stand out, right? Like if you go onto Fiverr and you look for people who will do a website designed for you or a logo design or you name it, there's hundreds of them and they'll start at charging £10 or £15. So you're just at a race to the bottom of who can do this the cheapest and the fastest. And it's really hard to build that into a sustainable business. And so I suspect that great to start, hard to sustain, but sounds pretty relatable. What really happened, if you think about this from Olivia's point of view, Olivia used to have one job, which was show up 9 to 5 at Acme Corp and do design work. She's now got two. She's got to do the project delivery work in her business, and she's running a business. And running a business is an entirely new set of skills. And by the way, if you want to start a product business where you build your own tool or your own software or your own app, it's the same problem, right? You've got the work of building the thing and you're running a business. And you're switching from being an employee to owning a business. And that needs a new set of skills. And the language that sits underneath that set of skills is finance, where every kind of domain has their own language, engineering has their own language, design has their own language, finance is the kind of language of business. And the important part here is Olivia's wearing two hats. She's wearing the hat of a designer and she's wearing the hat of a CEO or a business owner. And so if you think about it, you can classify the work she does into two parts. One part is working in her business, right? She's delivering projects, she's doing design work, or she might be building out her own product if you're in that kind of world. You might be dealing with some customer service, right? People will have questions. You'll need to meet your clients. Ideally, you're sending invoices so you can get paid. But all of those things I would broadly classify as operations, right? You're doing stuff. You're actively doing the work for the business. But there's a whole second part of work next to that, which is working on her business, right? It's asking questions around, how do I stand out? What is my brand, right? How am I going to get new business? Who are the people that I can buy it from? Who are people who could buy my service? Where do I meet those people? Should I go speak on events? Should I become an author on Medium? Like all those questions. What are my rainy day plans, right? What if I can't find new business for the next 6 months? How is my company going to survive? If you're in the product world, should you think about fundraising? Is it an angel question? Is it a venture capital question? So all of those questions, I think of as strategy, which is more to do with making a set of choices about what you're not doing and what you are doing in your business. And so as a consultant, I spend my time in that blue zone, right? Like I deal a lot with anything from small to large businesses, asking the question of how are you working on your business? And so really important part here is if you're wearing both hats, you need to work on your business, not just in your business, right? If all you're going to do is work in your business and do your design work and deliver work for your clients, you're going to ignore growing your business and kind of operating it. And eventually you're just going to end up feeling like you've got two jobs. You've got the job of the 9 to 5 doing the work, and then somehow you need to squeeze in all this other work as well. So just get yourself into that mindset. You have two jobs, right? You're an owner and an operator. And in fact, over time, you may decide that the thing you really want to do is only work on your business, and you'll hire people to do the work in your business. So you might hire more designers, you might hire administrative assistants to help you with the invoicing and the customer support. And suddenly you're running a design agency, but your job shifts from in to on. That's the key message there. That's the mindset you need to be in. Two jobs, in the business, on the business. Let's dive into the meat now of the actual finance, right? This is why we're all here. Numbers, fun, all that kind of stuff. And really, what you should understand is this picture, right? If you understand this picture, and by the way, like by the end of this chapter, you will understand this picture. But this is the picture you should understand, right? Revenue is what you're earning. That's nice, right? Revenue is the top. Profit is anything that's left after you've paid all the costs. And the obvious question then is what qualifies as a cost? So we'll deal with that in a little bit. But lastly, and most importantly, is what's the cash? What's the number in your bank account? And we'll go through an exercise that kind of explains this profit and revenues and cost. All of these things relate to cash. And ultimately, we all know that cash is the thing that pays for stuff. Let's go back to Olivia for a minute here, right? When I said that project that a friend gave her, it was an app design project and it took about 2 months, and they've agreed it was $10,000. But they also agreed that it was going to be paid 50% up front and 50% at the end. So $5,000 at the beginning, $5,000 at the end. And because Olivia started her new business and she had to give up her laptop back to Acme Corp. She had to buy a new MacBook, and it doesn't take much these days with a MacBook to get it up to $3,500. That's sadly the price they cost these days. From a finance point of view, the question is, how could we fairly represent this, right? Like what's a fair view of representing this business? And so the first and easiest thing is think about the money in the bank account, the cash, right? It's pretty simple. At the beginning of the project, she received $5,000 and she bought a MacBook. So Apple got $3,600. So the number that's left is $1,400. In the middle of the project, while she's working away doing the work, nothing happened to her bank account. And then at the end of the project, she got another $5,000 coming into her bank account. So you can see how this structure works, and we'll fill out this entire table as we go along. But essentially it goes, there's $1,400 on the bank account, and then at the end, there's $6,400 on the bank account. So now let's think about revenue for a second, right? When people say revenue, it means earning something. And so here's a question for those who are paying attention in chat. What was the revenue of this project? How much did she earn? Right? $10,000, 6.4, $5,000, something else? Dump your answers in chat. We'll get to there, and then we'll reveal the big secret in a second there. But while you're all making wild guesses, and I see some 10s, some 5s, this is going well. At least we've got a difference in opinion. Let's think a bit about revenue and earning, right? What does it really mean to earn some money? Earning money is really, you're being compensated for the work you're doing, right? You do something and then you get compensated. And so we could think about this from a timing point of view, right? Did she earn the money when she sent the invoice? Is that a fair kind of way of thinking about it? And it's unfair because the invoice she sends up front, well, she hasn't really done any work. So it's not really fair to say she's earned money, right? Like nothing for nothing. That's not how it works in this world. So invoice is a bad idea of representing fair earnings. Well, you could go, okay, fine. What about at the very end of the project? On completion, clearly she's done all the work. That's a really good guess. But now think about a project that takes 2 years. Would that mean that in the first year you earn nothing, and then in the second year you suddenly earned everything worth 2 years of work? So it doesn't really work either, because projects could be pretty long. If you're in the kind of digital transformation space or interim management or any of those where you're doing multi-year projects, it's kind of unfair to say you earned everything at the end of your project. You could argue when she got paid, when the money lands in her account, because clearly someone decided to send her money. She must have done something to earn that. But then, very important lesson here, payment isn't guaranteed, right? It's not because you send an invoice that someone else is going to pay that. 99% of the time it pays, but there are certainly scenarios where the other party might go bankrupt. They might delay the payment. They might not have the money in their account right now. So keep that in mind, like money payment is not guaranteed. It's a bad measure as well. And so how do you resolve this problem of fairly representing compensation for work done? And there's two pretty standard ways of doing this in the industry. One is to work on what's called a milestone basis, where you go, do you know what? Think about building a house where you would say, hey, when the foundations are done, we've earned 10% of the work. And then when the house, the outside walls are done, we've earned another 10%. And then when the inside walls are done, maybe you're at 50%. So have these milestones agreed. Typically more for larger construction style projects, or if you're building a full application in our world. The more common one for consulting and design projects is simply you take the total value of the project and you equally spread it over the length of the project. So a very simple kind of way of going. So back to the question in chat, the answer is you're all right. Everyone is correct. In fact, any number between 0 and 10,000 would have been correct. The thing you should have thought about was, when in the project am I looking? So put this in context. Clearly at the beginning of the project, no work was done, so no money was earned. At the end of the project, $10,000 of work was earned. So there you go, that's the value of revenue at the end. Halfway through, you're at $5,000. If you wanted to look at 25% through, it would have been $2,500. So really, everyone's a winner here. Whatever number you picked it was correct as long as it was somewhere between 0 and 10,000. So that's revenue. Think about it simply as a reflection of you've done some work and then you got compensated for that work. That's the simplest sort of definition of revenue. So with that, let's talk about costs for a second. And I saw someone in chat talk about, hey, what about this MacBook that will change? It will change. In fact, if you think about this, how do you think about a MacBook? At the very beginning, we said a MacBook Pro these days is about $3,600, right? By the time you've added some RAM and a bit of disk space and some other bits and bobs, it's not hard to get there. But you wouldn't buy a MacBook for every project, right? Like you wouldn't go, oh, I have a new client or a new design project. Let me run to the Apple store and buy a new MacBook. In fact, you're probably going to use it for a couple of years, right? These days, 3 years for a MacBook is not unreasonable. So if you think about that, if I'm going to use it for 36 months, a MacBook costs about $100 a month for your business, right? You buy it once and then every month you kind of use up $100 of it in that respect. So your MacBook is $100 of cost every month. And so this thing is called depreciation of assets. When people talk about depreciation, this is what they mean. They go, I have an expensive thing that I'm going to use for several years, and therefore I'm going to spread the cost of it over the life of the asset. And this applies to any long-term asset in your business. If you look at like bigger companies or different kinds of companies, you'll often hear them talk about something called PP&E, or plants, property, and equipment. And the summary, the gist of that is it's something your business owns. It's expected to be useful for more than a year, and it's expected to help you in the production of that revenue. Typically in our line of business, that's usually stuff like MacBooks or whatever desk you've got in your home office, screens, iPads, like that's the typical kind of stuff for us. If you think about something like a car manufacturer, they may have an entire plant with all the equipment in it to actually assemble the vehicle. So clearly that's a very different kind of asset. And so accounting defines all kinds of stuff about what's a good, useful life. Like typically, computer hardware tends to be 3 to 5 years as the normal rule. If you talk about stuff like a factory, that's usually more like 20 or 30 years that people expect it to have what's called a useful life. The important part here is, like when you think about costs, property, plant, and equipment is PP&E. So property is real estate, plant, typically more factory machinery, and then equipment is the kind of bits and bobs that go in there. So again, this is if you go read like official accounts, they'll often be referred to as PP&E rather than anything else, just as the group of categories. Leave it to your accountant to figure out whether it should be 3 years or 5 years or 20 years or whatever. Just understand that the cost of something gets spread over its life. And the reason behind this is in the same way that earnings compensate you for the work you're doing. You want to match your costs. You want to match your costs to that revenue. So you can say things like, you know what, for me to earn this kind of money, I had to spend £100 or $100 or $500 of costs in my business. Because that way you can start comparing businesses, saying like your cost of generating this money is different than mine. And so you can start comparing. So this is an important concept. If you're doing a theoretical accounting course, matching is one of the first things you'll hear. And the idea is really simple. The idea is you earn revenue for doing stuff and you have costs for doing stuff and you want to line them up. That's all it is. But it's a key concept in analyzing businesses together afterwards. So let's wind back to Olivia and our sample project. Again, at the beginning of the project, there have been no costs. Halfway through, i.e. 1 month, it's $100. And then at the end of the project, 2 months in, it was another $100, so $200 in total. So her costs, even though she paid $3,600 for the MacBook, actually from an accounting point of view, it was only $200. And because we've always said revenue minus costs equals profit, this is where the 4th grade maths comes in, right? 0 minus 0 is still 0. 5,000 minus 100 is 4.9, and 10,000 minus 200 is $9,800. So as it stands, with everything we've talked about so far, the company for this project had a revenue of $10,000 and a profit of $9,800. Yet somehow, from a cash point of view, there's only $6,400 in her account. This is a highly profitable business. Clearly, we ignored a lot of costs. But that's the general structure of why you think about it. And so let's take a step back and look at real costs of a real kind of freelance business. If you think about, hey, I'm going to run my own business, this is what you should be planning for. And costs typically fall into two buckets. There are costs for running your business, and there are costs specific to a project. So costs for running your business, you're going to need some kind of Microsoft Office or G Suite, you'll need an accountant, you'll need some insurance, you'll have costs of marketing. You want to probably be on a few events. You might want to have a website hosted somewhere. You've got costs for employees. Keep in mind what you're wearing two hats. You're the owner and the employee. In your employee hat, you've got costs. You need to earn salary. You want to do some training. So all of those are costs of just running your business. On the other side, you got costs related to a project, right? If you need to travel to a client, you wouldn't do that if you weren't working for that client. So that's a cost, that's more of a direct cost related to the project. Again, there's long accounting discussions about what isn't the direct cost and a kind of an SG&A, kind of selling, general and administrative expense. But just remember two kinds of costs, right? Costs for running your business, costs for doing your project. To give you an idea of where some of this nuance or some of the kind of difficulty sits, if you are the person who is delivering the work for a client, are you a project cost or a business cost? Because you could argue it either way, and this may be the answer is 50-50 because you're wearing two hats. And so I put stationery in there just because it's something that you wouldn't buy if you weren't doing it for that particular project. Again, they're examples, they're not hard and fast rules. Your accountant will know how to qualify them in your situation. But the point is, these are things your business buys or uses to produce that revenue. So let's kind of go back to Olivia's project and update our table a little bit more. Revenue hasn't changed, right? That's still $10,000 at the end of that project. The direct costs, let's stick with just the MacBook for now. So that's that $200 we talked about before. And then her kind of costs of running the business. Let's say that she took out $3,500 in salary for 2 months. So that's $7,000. And there's $800 worth of general expenses on subscriptions and Figma license and God knows whatnot. So it's not that hard to get up to a couple $1,000s if you're just running your business. So that leaves her with a pre-tax profit of $2,000. Right? 10,000 minus 200 minus 7,800 leaves you 2,000. And because you're making a profit, no matter which country in the world you're in, the government's going to want their piece. So let's assume there's about 20% tax rate on that, or $400. So that leaves her with a profit, an actual net profit at the end of the day of $1,600. So $10,000 came in at the top. All said and done, $1,600 remained in profit in that business. And remember when I started, I said, hey, business is this, like finance is the same for big and small businesses. This is numbers from a company called Huron Consulting. They're a big public company. You could go to Yahoo Finance and you'll find these numbers. But this is public data for public companies. And you see that same structure appear, right? Like it starts with revenues, and these guys had total revenues of about 1.4 billion, because this is in thousands of dollars. As I said, it's the number of zeros that makes a difference, right? So they did 1.4 billion, 1.398 billion in revenue. They then have a bunch of expenses, which they call operating expenses. So some of those are direct costs. In their case, that's typically consultants who do the work. They got selling in general on there. They got depreciation. Remember, that's the whole cost of a MacBook over the life of the MacBook, which leaves them with an operating income. I'm going to skip over the interest part. Basically, they had some debt and then they had to pay interest on that. So that gets to be reflected in here. But it leaves them with about 83 million of income before tax. And then they take a tax break of that. And so they have a net income, or what's called profit or net profit, of 62 million. So Huron Consulting took in $1.4 billion and ended up with 62 million in profit. That's about 5%. If you open a calculator and you divide 62 million by 1.4 billion, you'll get to about 5%. Let's compare and contrast, right? Huron Consulting did about 5%. Olivia had $10,000 in revenue and 1.6 thousand in profit. That's about 16%. Oh, that is actually exactly 16%. So which business is better? Just purely on a profitable business, Olivia's business is definitely doing better. So this is how you can compare and contrast and see how businesses are doing. And as I said, it's the exact same even for our kind of simple Olivia project or for a genuine, real big business. It's the same approach, the same way of thinking about it. There's no real big difference here. Those of you who've been deeply following along already will have seen that I've carefully ignored talking about cash here. And this is why. If you think about Olivia and the cash in her business, right? First thing that happened was the first invoice. So her balance went up by $5,000. Right? She then went out and bought a laptop. So she spent $3,600. There's $1,400 left on the bank account. She then paid herself salary 2 months. That's $7,000 that went out. Paid subscriptions and whatever else. Suddenly her bank account is $6,400 below zero. She then invoiced for the second one and another $5,000 came in. She's still $1,400 short on her bank account. And so, while highly profitable project, right? Like 16% versus an industry competitor who's at 5%, very profitable, somehow runs out of cash. So if you're Olivia, you're not really running a business, you're mainly running an overdraft. Or you couldn't even do this because you might not even be allowed to go negative on your bank account. So wrapping all this chapter up into my one amazing meme that I found, this is why this is so important, right? Cash is the absolutely most vital thing in your business because cash pays your bills. Anything else is accounting, is conceptual. At the end of the day, it's the cash that will pay for your bills. And so the timing of your cash, when it comes in, when it goes out, really matters, right? You've got depreciation that smooths out some costs. You've got things like accounts receivable, which represent future money in. But really, the number on your bank account is the thing that will pay you for food on the table, keep the lights on, and whatever else you want to do. So I hope the one thing you take away here is that like, revenue is great. That's important because you need to know how much you're earning. Profit is amazing because that means your costs are less than your revenue. But really, the one thing that truly matters is the cash in your account. If you do one thing as an owner, look at your bank account regularly, maybe not quite daily, but at least weekly. Make sure you know the number on there and get comfortable with how that number behaves and goes up and down as subscriptions come in or out. So that's all the theory you need to know: revenue, profit, cash. Let's kind of put that in practice because that's why we're here at the end of the day. And recap, because I've been waffling for quite a bit and there was lots of numbers flying around. Like, you're a business owner. Don't forget that. You wear two hats. You're part of your business doing work. You own this business. That's a part of the work on your business. Finance, as we saw, same for every business. Doesn't really matter what kind of business you're in. The structure and the thinking about finance is the exact same. And cash is something you really care about more than anything else. So how do we use this? First of all, let's understand our business as a business, right? Put on the owner hat, ignore the employee hat. You're running a business. So first of all, profitability, pretty much what we talked about there, right? You take your profit, you divide it by your revenue. How much of every dollar that comes in do you keep? And when I say you, keep in mind that sort of as an owner, the profit that the business makes is what you have the right to. That's yours. That's your value. So profitability is a very important kind of measure in that respect. The second part is cash runway. As we saw with Olivia, basically, when do the lights go out? So if you think about Olivia and the kind of cash flow, right, she spent $3,600 on a MacBook. What if she rented the MacBook, right? Rather than spending $3,600 on day one, what if she rented it and spent $110 every month? Actually, that might have changed her cash flow quite a bit and may have been a lot better. So those are kind of considerations. Once you understand how cash goes in and out of your account, you might think different about buying something versus renting something. As a consultant, I think for those of us who are, the utilization rate is quite important as an internal measure, right? How much of your time are you actually working for clients? How much are you billing? And so if you need tools for that, Harvest is great. I've used Noco before. Timing app is up and coming. But all of these things just help you in managing that flow. And sort of you don't have to do it in the calendar. You can just do it in the system outside of that. And really, probably the key question that we're sometimes struggling with is like, how much should I charge? Like, how much can I ask for this thing? Once you understand financing and your own company structure, you know how much you cost the business, right? Between your salary, what you would like to see in profits, some costs you've got to generate the revenue in terms of your MacBook or whatever else, you can come to a number that goes, actually, for me to do an hour of work for a client, I need to earn at least this much money to cover my costs. So that gives you a minimum you should charge. And then the other side of that equation is how much can your client pay, which is more of a discussion with them. But somewhere between your minimum and what they can pay is your price. Never go below what you cost. And ideally, if you want a project, don't charge more than your client can pay. That's the sort of simple maths behind all that. But really use your kind of finance knowledge, even if it's as basic as what we went through here. Use that to understand how many hours am I going to work, and therefore how much should I charge to cover all my costs and have something left in the business as profit. So that's one thing. The second thing I want to touch on is when we think about a contract, quite a lot of us probably just go, yeah, I'll just sign this. I'll read it. I won't care too much about it. I'll read it and I'll sign it. Contracts are really an exercise in thinking about what if it goes wrong. Like as a business owner, what if this project goes wrong? So look for protection in there. Look for clauses about how do you get out? What do you have to do to stop something? Also, there's quite a few things that, besides the kind of the price you agree, there's quite a few other bits in there, particularly when you think about cash. Remember, we said cash, most important thing for a business. So two things you should absolutely look for and probably negotiate is the billing schedule. Right? When can you invoice? Can you invoice up front? Can you invoice every month? Can you only invoice at the end of the project? And then the second step in invoicing is the payment term, right? You sending an invoice, how quickly is that going to be paid into your account? You sending an invoice doesn't mean money in your account. The money comes when someone pays your invoice. So really think about those two and see how they relate to cash in your business, or from your client's point of view, cash going out of their business. So when you think about contracts, at a minimum, have a look at the rules around when can you invoice them and how are they going to pay. And don't be afraid to negotiate those. It's fine to ask for faster cash or more regular invoicing or something up front. Those are all common things, but they're usually not the opening offer in a contract. As I said before, and I hope if you remember one thing or screenshot one thing, like this is the one where you should take a screenshot, right? Cash flow is the rhythm of your business. Understanding how that behaves really is understanding the sort of the heartbeat of your business. And so when you think about cash flow forecasting, I promised no spreadsheets. My cop-out is that I've got a group session set up on ADP, I think it's next week, where I will literally open a spreadsheet with anyone on the call, and I will build out a cash flow forecast probably for Olivia's business. We get to see her back and we can talk a bit more about the stuff she gets up to. But the idea of this is, I think of it as broadly right, but precisely wrong. In other words, you want to make sure you capture the big movements in cash, but because you're trying to predict the future, you're never going to be exact. The link to this session, I don't know if I can paste it in the chat here. Otherwise, the session is called Cash Flow Building, or just go to my ADP profile. You'll find it right there. But that's what I'm going to do. I'm just going to sit there and we'll spend probably about a half hour building an actual spreadsheet, and we'll work through how does cash go in and out of the business? What does that mean? We'll also probably touch a little bit on how do we then think about invoicing and how many hours should we work? So we'll really construct the sort of the theoretical part of a cash flow. So I'm not going to belabor the point here. Just hop on next week and we'll do a lot more around cash and cash flow. Now, the most important part, you own this business, right? Enjoy it. You own the business. And the important part about owning a business, as I said before, is that you have the right to the profit. And we'll come back to that in a second. But there are certain expenses that you would make for your business. Employee training, remember, two hats, owner, employee. You're an employee. If you think this training makes sense for your business, get your business to pay for it. Don't pay for it yourself. If you want to attend an industry event or a conference, again, get your business to pay for it. If you had a full-time job somewhere at a big company, you would probably go ask your manager, and they would ask their manager, and then HR would get involved about you getting a ticket to a conference. The good news is have a discussion with yourself, because you're both the employee and the boss. Get your company to pay for these things. We're all working from home, or a lot of us are working from home these days. I've got a desk and a big screen and a laptop and an iPad and some other shenanigans. My business owns those, because why wouldn't I? I wouldn't buy these for myself. They are for my business. any laptops and iPads, clearly that's stuff for your business. I'm not going to sit here and tell you about doing stuff that is clearly not for your business. If you're in design, woodworking might be a bit of a stretch to justify, but generally there's lots of costs that you could think about that are probably better paid by your business than by yourself. Also, you're the employee, pay yourself, right? Get yourself a salary, get yourself a 401k or a pension or anything like that. And as an owner, you have the rights to the profit. And so where this differs is in typically, I'm going to speak for the UK here, but every country is similar, where the tax you pay on the salary tends to be higher than the tax you pay on the profit of a business. Talk to an accountant, like they will help you. Like accountants are really good at telling you should take like this amount of salary and then that amount of profit in your business can come to you in this way. This is not a personal finance course, so I'm not going to go too deep into that. But fundamentally understand that you've got more than just salary to do stuff for you, right? Like you could get money in your account. You could also have fun by the business paying for things that you would like to do. Play with that. Have fun. Be an owner. Enjoy it. And last thing I'll say, some closing thoughts, is I talked a lot about this idea of two hats, right? Like you probably got by now that a business is more than just doing the delivery of a project. And so you need to have some motivation of wanting to do this business. Like you might want to do it because you really never ever want to work for a big company again. You might want a little bit more flexibility in the projects you attract. There's any number of reasons, but you need to be motivated. You're not going to do a 9-to-5 job. You're going to have a kind of a lifestyle that involves owning a business. You're going to need to be somewhat social in the sense that you'll need to go out there and attract new clients and probably talk to people or be on these kind of events and be a speaker. So you're going to have to be out there. You're going to have to get a little more comfortable with finance and the sort of the roller coaster of some months are going to be great and you're going to get lots of invoices and lots of project work. And some months are going to be less great and you're probably going to be looking at, where's the next paycheck going to come from? So there's no right or wrong here. Just be aware that running a business is another thing. It's a job and therefore enjoy it. But think about, do you really want this before you start? And with that, I'm going to get onto the Q&A. Preet, I see you pop back up. So I'll leave it to you to moderate and host the Q&A and then I'll have an opinion about stuff.
Yes. So first of it was a really insightful session. Like going through the entire Olivia story and like the whole storytelling, like the whole concept of finance through storytelling was really interesting to know. So yeah, thank you so much for that. So we have 3 questions in the Q&A box. So I would like to add that on the stage so that everyone can read it. So here's the first question. What key financial strategies have you implemented to manage your finances effectively as a creative entrepreneur? And how has financial literacy impacted business decisions?
Sure. I see someone from Hustle. So I'm Belgian, so I'm from Ghent. So it's good to see a fellow, even though I live in London, it's good to see a fellow Belgian. In terms of sort of key strategies, for me, I have a spreadsheet somewhere because there are spreadsheets eventually in finance. You can't avoid it. But I have a spreadsheet where I have a cash flow prediction for my business. I did it early on. I've been running my own business for several years now. So I no longer need the spreadsheet to understand what's happening. But I have a model somewhere that goes, hey, my cash kind of evolves in this way. And therefore I know when I should be invoicing, when cash should come in. I have certain fixed costs that go out. So in terms of sort of key strategies, I have gotten a really good handle on my cash flow. Like I pretty much could tell you without looking at my bank account at any given point how much money is in my bank account. And so that's a strategy. The other part you might think about, and this is probably more if you're doing a kind of a sort of a B2B business, is there's a thing called factoring your invoices, which is essentially you close the gap between invoice and payment by giving your invoice to someone else. They will pay you and then they'll worry about collecting the cash in between. And in the process, they take a small amount of money. It's called factoring an invoice. But the key thing for kind of small entrepreneurs or creative entrepreneurs, I think really is going back to understand that your business is entirely driven by initially how many hours you work, how much you charge for that, and how quickly you spend the cash in your account. And so if you have a spreadsheet, kind of putting those three variables into a little flow will be enormously valuable to you to understand when and where you need to worry. And then financial literacy, how has this impacted my business decisions? I think I'm probably the worst example because I studied all the stuff long before I started my own business. Like I did corporate financing for big companies, so I'm used to dealing with investors and CFOs, and I've been in rooms with people who are worth billions of dollars negotiating, buying businesses. So I guess for me, it's more a case of I've just seen it applied at big businesses first, and then when I came to my own business, I realized that hey, this is the exact same stuff. Right? There's no difference between the sort of big business finance and small business finance, so I can apply the same tools across it. Does that help with the questions and give you an answer? Preet, shall we move on to the next one?
Yes. I just thought that she will respond to the message, but yeah, it's fine. So we can have another question. We can look into it. So here's another question.
Let me have a quick look. The new face in Israel, keeping cash flows is something.
What consideration? Okay.
So I would turn that question around, and I think about cash in ideally should be fairly predictable. Now, that's not always the case, particularly in the early stages where you may have a project, you may not have a project, suppliers, or you might get paid later than you anticipated. So smoothing out your incoming is the first part to look at. The other side, and considerations before you go dry, is I tend to think about my costs, the costs in my business, my cost structure, as a small bucket of things that are not negotiable and a large bucket of things that I can turn on and off at any given point. So for me, the non-negotiables are not much more, frankly, than what I pay for my email and my website and my salary. And I'm like, in the UK, you tend to take a salary of a couple £100 a month because the rest is somewhere else. You have to look at your own business, your own life as well, and how much money do you need personally going through? Because you might have a mortgage, you might have children in school. Somewhere you personally have a number that says, if I earn this much money every month in my personal account, I can live. Like I can do what I need to do on a personal level. I can get food, I can pay for my house, whatever it is you've got, right? You then go flip to your business and put on your business owner hat and say, okay, fine. This is the money that needs to come out of my business into my own pocket every month. That gives you the sort of minimum spend you've got. Right? Then you have a little bit of extra of, okay, did these things keep the business tidying over? Typically in our world, it's not much more than an email and a website. Anything else on top is cost you can turn on and off. So you can model this out in a spreadsheet. Again, there will be spreadsheets, I am sorry. But you can put this in a spreadsheet and see, okay, fine. I need cash to come in at this point, or I need this much money to cover my costs. I think before you run dry, you should never run dry, I think is the answer. Like you should have visibility on this 3 months, 6 months out, so that you have time to react to it, rather than go, oh no, tomorrow I need to pay this money and it's not in my account. Like flip that question ahead and think 6 months. I think one of the slides I had early on talked about what you do on a rainy day, like as part of your strategy. Like this is where this applies, right? Like your rainy day plan is I can run 6 months without income. So that gives you at any point 6 months to go find the next paid project. So think about it that way. Think about planning ahead rather than hitting that wall.
Okay, one last question before we wrap up. So the question, is there a ratio that you should be investing profits back into the business versus keeping some profit for yourself?
So no is the answer. There is no number that I can give you that makes sense, because that's a decision you need to make for yourself. I can give you some guidance on how I think about that. And I think about this mainly from a tax point of view, right? And then, okay, at the risk of going a little bit philosophical here, but I don't care about money. I care about what the money does for me. I don't really care about how big the number is in my personal bank account. I do care that I can buy nice equipment for myself, afford to live in my house in London, right? All these things need money, but the number itself doesn't really matter to me. So the way I think about it is the most expensive money is the money that ends up in my personal account, because I will have paid company tax on it and I will have paid personal tax on it. So my account can optimize the personal tax part, but it's still money that I give to the government to then just end up with a number in my bank account. So in terms of reinvesting, my general strategy is absolute minimum to myself, leave most of it in the business. It might sit in cash in the business, or I might put it in a savings account, but that's another form of reinvesting, right? If you've got a pile of cash in your business, you might think about, should you hire some people and maybe see if they can drive extra revenue? Those are all good problems to have, right? You might think about going to a high yield savings account in your business and just putting the money away. These days, you could get 5-6% on a good savings account. Easy money if you've got nothing else to do with it. So rather than reinvesting, ask yourself, A, in my business, do I have something that's worth reinvesting in? Do I have a project that actually has a reasonable chance of reinvesting and making more revenue? Is the money better sitting in your business, or is it better sitting in your personal account, depending on what you want to do with it? So that's how I think about leaving your profit in your business versus pulling it out.
Okay, so I think that's the end of this session. But for the people who are interested in the another session with Klaas, which is regarding to cash flow building, I have already put the link in the chat. So don't forget to do the RSVP for that. It's on 25th of September. So make sure you can RSVP as soon as possible. So that's it. Thank you so much, Klaas, for your insights. It was really interesting.
Thanks for having me.
Thank you so much, everyone. Thanks for attending. See ya.